Welcome to the Leaders in Payments podcast, where we talk to C-level leaders from across the payments landscape. We'll be discussing the products and services that impact the payment space today, as well as trends and predictions for the future of payments. We will also hear stories from our guests about their journeys to the top.
Hey everyone, this is your host Greg Myers, and on today's Pulse of Payments episode, I'm going to be talking with Brian Shniderman, the CEO of OPI and the Chief Strategy Officer for OpenPay. The topic for today's episode is one of the hottest trends in payments, buy now, pay later. Not a day goes by without an article being written or an announcement being made in this space. From Square's acquisition of AfterPay to Apple's announcement that they're partnering with Goldman Sachs to offer a buy now, pay later solution. OpenPay offers a unique buy now, pay later solution in Australia and the UK and will be launching in the US in Q4. Brian starts by providing a definition of buy now, pay later, one that I think you will find very interesting. And then we discuss the value to merchants and consumers. We also talk about the US and global landscape, some of the trends in the space, and why buy now, pay later has exploded in the last 18 months. If you want to learn about this space, this is the episode. So let's get started. Hi, Brian. Thank you for being here and welcome to the Leaders in Payments podcast, and more specifically, this Pulse of Payments edition, where we're going to focus on one of the hottest trends, if not maybe the hottest trend in payments today, buy now, pay later, also known as the acronym BNPL. So, Brian, welcome to the show.
Thanks, Greg. Thanks for having me.
Absolutely. So before we dive into that, tell our audience a little bit about yourself, maybe where you grew up, where you went to school, where you currently live, a few things like that.
Oh, boy. So going way back here. So I am originally a native of California, though I've spent more nights, I think, in New York working than any other place, any other bed that I've lived in. The majority of my 33-year career, which has been all in payments and fintech, was really about half of it was over at Deloitte, where I launched their global payments practice in 2006. And grew that to across 64 different countries. And I was very actively involved throughout my career with not only the merchant side, but the financial services side of payments and fintech, issuers, acquirers, processors, networks. Have served those all my life. And then also in public sector. So I've helped several governments, for example, move to real-time payments, helped the Federal Reserve. So that's what I've been doing professionally. And then personally, I spend my time when I'm with my home in Paradise Valley, Arizona, which is just outside of Scottsdale. Very active with my 3 kids and my wife and my 2 Labradors. I'm kind of an outdoor guy. So that's a little bit about me and where I came from. School-wise, I've been at like 5 different schools. I have a collection of undergrad and graduate degrees from various state and private universities and postgraduate work as well with Harvard and some others. So a whole collection there.
Okay. So let's talk about the company. And I want to make sure it's clear because there's OPI, which I think is launching in the US, and then OpenPay, which has existed for several years in Australia. So maybe talk us through those brand names and what exactly you guys do there.
Yeah, absolutely. So we'll first talk about OpenPay, the parent, which was my client when I was at Deloitte. And I saw this incredible opportunity to close a gap in the United States. And that's really what led me to join them. OpenPay was originally founded as a merchant-developed solution. A merchant that was actually in the clothing industry had the need to provide an installment product for people buying, I think it was higher-end, plus-size clothing. And the market really understood in these other countries the demand and the need to have an installment product to pay over time, and necessarily something a little bit more expensive than maybe your average t-shirts and tennis shoes. And that evolved. It was a flat fee product. And that's really important here because sort of like in the investment world where you have some advisors that charge 1% of your assets every year and take that big amount of money for providing their services versus a flat fee advisor. This was a company that was simply charging a very nominal flat fee each time you made your installment payment. And it was very powerful. And I think they started to realize how powerful it was and split it out to be its own company and its own entity, and hence OpenPay, which was then brought to Australia, New Zealand, the UK, and then ultimately through some strategy work that I did for them, coming to the United States, where I joined them the first of this year, 2021.
Okay. And your current role there is CEO?
I'm the CEO of the United States, and I am the Global Chief Strategy Officer. So I have both a global responsibility as part of the executive leadership team, as well as running the U.S.
And the name for the U.S. is different than OpenPay. Is that right?
Yeah, it's a funny story, actually. In the U.S., the entity is OP, which is our ticker symbol, OPY, OPUSA. And the story there is that there is a certain very large network that owns the word open, they feel, I guess, at least. They have a small business line called Open. And there were some concerns, I think, all around that they didn't want us to use that term. So we decided, instead of using OpenPay in the US, that we'd use our ticker symbol, which is OP. Got the domain, opy.com, which is a nice, easy one. The product itself, OPPay, is how we refer to our OpenPay Buy Now, Pay Smarter product in the US. And we'll talk more about why we call it Buy Now, Pay Smarter instead of Buy Now, Pay Later. We also have B2B products and solutions that I won't talk as much about today, but just so people know, we're a more diversified payments fintech. We have solutions that help buyers and suppliers, and in some cases, integrate credit into that process, into that flow. So, yeah.
Okay. Are you live in the U.S. now?
Yeah, so our U.S. business goes live in the fourth quarter. Right now, we're going through the process with all of our funders and all of our ecosystem partners to set up and integrate and to Americanize the product. Obviously, this product is a regulated product. We're fully regulated. We're not a pay in for, which is incredibly important, meaning we have a lot of responsibilities that we have to take care of and Americanize the product for all of the statutory as well as federal requirements and preferences. There are unique preferences in the US for consumers that don't exist elsewhere. Sometimes it's across the board. Sometimes it's, interestingly, within a specific vertical. Healthcare is a really good example. We have a very different approach to healthcare in the United States, for better or for worse. Unfortunately, oftentimes, I think for the worse, but it carries the need to tune the products to various verticals. And in the healthcare space, we do things a little differently, which makes it very tailored and drives a lot more value for that vertical. But we're getting all those requirements embedded in our solution, Americanized solution, with our partners, with actually our customers. So the customers are very engaged in helping us define what those capabilities and requirements are. And that's what's happening now. And yeah, we'll turn on the actual flow of all the stuff we've lined up quite a bit, a very sizable amount of pipeline that will start flowing through Q4 and then really big time in Q1, Q2.
Okay, exciting times. Well, let's dive into the buy now, pay later space. And I don't think I have to spend a lot of time telling or convincing the audience that this may be the hottest trend in payments. And today we're recording this August 3rd. And so yesterday, as most people probably are aware, Square made an announcement they're acquiring AfterPay for $29 billion, which is really just one of many recent announcements about this space. I mean, there was the Apple announcement not too long ago, and I don't think you can read much in payments without seeing that acronym in a headline somewhere. So let's dive into that, and really let's sort of level set, if you don't mind, and define what buy now, pay later is sort of at a high level, so we're sort of all on the same page as we move forward with the conversation.
Yeah, and it's really important. Not enough conversations start there because there really are different types of buy now, pay later. And the differences are very, very important. So what most people think of when they hear about buy now, pay later, most of these large players, including those recently that made some big announcements as you're talking about, focus on pay in 4. That means you get 4 installments to pay for something. Typically, those will be over 2 months. So you got 60 days to pay for something. And that tends to serve smaller dollar transactions. Clearly, if you're going to replace your transmission for $5,000 or more, you're going to most likely want to pay it off over a longer period of time and more installments. And so the pay in 4s really serve what I like to call the t-shirt and tennis shoes market. Typically younger, closer to 20, and not sort of the older, more financially mature and sophisticated consumer who's replacing or repairing their roof or their transmission or putting braces on their kids. So it's really important to understand that, because not only is it a different product that they're buying, a different basket they're buying, different merchants that tend to serve t-shirts and tennis shoes, but it is also not regulated like the longer term installments. So in most markets around the world, including here, if you're doing one of these longer term installments, it is technically a loan and it is regulated. And of course, that carries a lot of burden for the provider because every state has a different requirement, statutory requirement for lending. In some cases, you have to have actual people that are there full-time sitting in an office. Believe it or not, that's, I think, Nevada. In other cases, you have to have certain financial assets. And it is very, very complicated and much more expensive to play in bigger than Pay in 4. And that's one of the reasons why many stay to just Pay in 4. And that's great. I think there are some challenges with that model. The other model is those that are longer term installments. And so those like us that can go longer, we are one of the longest out there. In some markets, the longest. We'll go 24 months. We'll go up to $20,000. And so certainly if you're remodeling your house and you're trying to pay for a appliance package of all the really nice higher end appliances, that becomes very, very useful to do that over a couple of years. It's not applicable to Pay in 4. The margins are actually much healthier. The volumes might be smaller than all those t-shirts and tennis shoes and smaller items, lipstick and things like that, but it's a very healthy business. And so those are the longer term installments that really start to become similar to some traditional consumer loans that have been out there. And there are some players that provide those. And that leads me to another aspect of definition, not just the length of the term and the number of installments, but whether it is interest bearing or not. So across both of those, you have some that say they don't charge any interest, but they have other gotchas because clearly they have to find a way to make money. They've got tricks and gimmicks and gotchas that get the revenue. So the interest products can get up there. Of course, credit cards, 36% higher. You're talking about a very expensive interest rate and APR. And for 30 days, when you don't pay it, it's not a big deal. You start to get into 60 days, and it's less compelling than a Pay in 4, which even if it has an interest or fees, it's still pretty attractive to go with the Pay in 4 than the credit card, right? So you have a lot of people out there moving away from credit cards and saying, oh, I'm going to use this Pay in 4. Then you have these products that are very rare, extremely rare. And that is the combination of something that can go larger, up to $20,000, longer, 24 months in our case, and has no interest. Basically a flat fee. Every time you make a payment, you pay a flat fee. Might be $5, might be $10, depending upon the size and the length of the loan. And that is what I was looking for my clients when I was at Deloitte. I was looking for something that would go larger, longer, have no interest. And one more aspect of these sort of core 4 elements was something that was integrated into the verticals, integrated into patient management systems for healthcare, integrated into the dealer management systems for the auto repair and service industry. Because in the world of payments, as many of your listeners know, that creates a very powerful combination, reduces friction, it increases the value, the ability to do certain things like reconciliation and other things. It is a very powerful combination to be deeply embedded within the technology. And so larger, longer, vertically integrated, and no interest ever. So let me pause there and see if you have questions, because I do want to talk a little about the gimmicks and the tricks that help those that I talked about with that zero, quote unquote, interest to exist in this ecosystem, to understand that definition, and because it's not what it appears to be at face value there. So
yeah, just quick question. So where does the regulatory start, or why is it the number of installments? Is it whether you charge interest?
Nope, number of installments. That's the trigger. So that's why we call them Pay in 4s. Once you pay in five installments, now it becomes a loan. And whoever designed that regulation had, I guess, felt that that was the best definition of what was just a payment plan versus an actual loan.
Yeah. And then if you want to keep going with more around the definition, that'd be great.
Yeah. So it's really important for people to understand that you need to look at not only interest rate, but you need to look at APR, and you need to look at these gimmicks and tricks. So if a consumer is offered a loan with zero interest, there is a very large group of pay in four providers that say, if you're a day late or a dollar short, you're going to pay back interest. In other words, forget everything we said about free, zero interest. We're now going to go backwards. And while you may have had a mistake, you missed a day, you were a day late, or you were a dollar short, we're going to kick you when you're down. And we're going to make you pay a massive back interest as though your product was never zero interest. I think that's not fair. I think it borders on not being transparent. Although they do disclose this stuff, we all know most people don't read that fine print. And if it comes from a trusted party like a dentist or your auto mechanic or your educator or your contractor, even worse, because people are expecting those that distribute these products, these merchants that participate, to be looking out for them. I mean, it might be the second or third generation going to that dentist, right? And so you've got these products that carry these traps and these tricks, these gimmicks, not only back interest, but there's something called deferred interest, where, yeah, you're going to pay interest, but it's zero now. But fine print, you'll owe it to us later. Lots of problems with that. Massive, proportionate, which drives up APRs, the effective rates, penalties. There are organizations out there making a ton of money off of penalties. And so all of these in this category are betting on those customers that are going to have a problem and taking advantage of them when they're down. And when I envisioned a product for the US to really redefine what it means to have instant credit at the point of sale, something that would drive up sales for merchants, drive revenue, drive margins, and we'll talk a little bit more about how it does that. I envisioned something that was exactly what all my clients were asking me to go find. Larger, longer, verticalized, no interest ever, no gimmicks, no gotchas. And that didn't exist in the US. It simply didn't. But I'd heard there was a company called AfterPay in Australia that had it, but they weren't launched in the US. And then I got a call, it was about June of last year, from one of my fellow Deloitte partners out in Sydney. And he said, I got a client in Melbourne and they want to launch in the US. They want a consultant to help them. And that's where I said, well, who are they? And he said, AfterPay. I said, oh, we've heard of those guys. Those guys are the ones that I've been using as an example, but I've been telling all the merchants here it doesn't exist. And so he introduced me to Michael Idell. And not only was I absolutely convinced that this product was needed in the US market, at the same time, of course, COVID was happening, and the appetite for the general buy now, pay later was growing red hot. And I think what you'll see is as our product launches in the US, it'll be white hot as we're starting to see the demand, even before we've launched, to be very, very high. That's why we call it Buy Now, Pay Smarter. It has all those elements that redefine. It's sort of the second generation, next gen BNPL. It's all about helping the consumer and the merchant without taking advantage of them if they're in a difficult situation.
Yeah, I would think, we're going to talk a little bit about the value to merchants, but just in what you've said so far, I would think a consumer who is buying from a merchant and then they fall into one of these traps, like you said, they're going to go back to the merchant. So that's got to be a challenge from a brand perspective. So just something that I think any merchants that are listening sort of need to think about. It's a hot, sexy product, but sort of be careful in how your consumers might view it.
So on one of my podcasts, I actually interview a customer because I kept hearing this a lot. I interviewed somebody that went into their dentist's office and had overheard a shouting match between a parent that got apparently braces for their kids and was offered this buy now, pay later installment credit card product from one of our competitors. And it caused them to get into a debt trap that they couldn't get out of. And it was damaging their credit and things like that. I think it's really important that these merchants that consider themselves consumer-oriented and a friend of their customer, which frankly should be everybody, but certainly in the medical industry, the contractors, the mechanics, the educators, these are people that are really supposed to be out there helping and looking out for their customers, that they don't put these products in front of them. It would shock you how many of them not only put those products in front of their customers, but they actually exclude, they've signed exclusivities So they exclude the customer from getting access to any other product, including ours. I can't tell you how many organizations we talk to here now in the US that say, hey, we love that product, but we signed something with one of your competitors, a pay in four, and they won't let us offer anything else. We can't market, we can't tell people about it. No choice. And yet we're going to put this debt trap with all these gotchas and gimmicks, zero interest. It is absolutely shocking. It does have an impact, and we are seeing it. I saw it firsthand when I was dealing with the merchants. So I think your cautionary note is well taken.
Well, let's flip over and talk about it from the consumer side. And obviously, the financial benefits make sense. But can you talk about what types of consumers, whether they're more the Gen X and millennials, and you mentioned that a little, or sort of what does the consumer makeup look like?
Yeah, so for the definition that entails these pay in fours, it tends to be younger, closer to 20 years old, and then starts to taper off as you get into the 30s and 40s. Our product, our average customer for our flat fixed fee, it's a more financially savvy customer that tends to be, we find, closer to their 40s, if not in their 40s. So you do see a difference in using this as a responsible tool. I know exactly how much to budget. I'm going to budget this amount to pay for the braces, and it's never going to change. Even if I have a late payment, it's always going to be an additional $5 that's going to be tacked on to each installment. I can plan for it. I can budget for it. That makes sense. In the US, our product is always a single-digit APR. Now, we don't charge an interest, and a lot of people don't understand this, but we're a flat fee. But from a regulatory standpoint, you have to disclose, if you have a flat fee, you have to disclose it as a percentage of the total value of the product and the loan. So it is that ratio becomes an APR. Our APRs in the United States are pegged at always being in the single digits. What you compare that to is almost all the other BNPLs are at 14 at the lowest, and then you see them go up to 36% and higher. So it's important to understand that the persona, if you will, of somebody using these products that's looking into how much is this going to cost me, can and typically does look at the APR, not just is there interest or no interest, are there gimmicks and no gimmicks, but what is this going to cost me as a percentage of the loan? And if it's in the single digits, it's most people understand that's a very responsible level of spreading a payment out. If you can be in, say, 5 to 9.99% range, which is kind of the range we operate in, that's pretty attractive. Yeah, a lot of these, if you're a small business owner, and a lot of them commingle their personal and business expenses and methods of payment, right, the cards and things that they use, they'll look at this and say, well, my cost of capital is higher than a single digit for my business. So why would I fix my leaky roof for $10,000 or $5,000 for the car repair? If I can borrow at a single digit APR, it's cheaper money, right? So it works out. It's a win-win. So that's really important to understand because that persona is quite different than the teenager who is trying to buy a $200 pair of tennis shoes and simply doesn't have sufficient income for it. And what I worry about on that, Greg, is a lot of these young people that are getting into these products will have 2, 3, 4, 5, maybe 10 of these out there now. And there is no consolidated way to track it, to manage it, and they'll end up missing payments and they're going to damage their credit history. That worries me. I think these products, personally, I think these products are best suited to somebody who is more savvy about and educated about loans because they are loans. In my mind, they are all loans. I think eventually the Pay-in-4s will be regulated. I think they should be regulated. And I think people need better disclosures and better awareness and better advisors, whether it's the merchant or their accountant or whomever, telling them how to use credit. I think it's really important. And so there is a period of time, I think there'll be a shakeout that will happen. And I don't think a lot of these Pay-in-4s that are built on these other consumer value propositions in the long run are going to be as healthy and successful because of that. I think they'll have to evolve or, again, maybe be acquired.
So I think you've kind of touched on it a little bit, but can you talk about sort of the landscape in the U.S. and the landscape globally just at a high level?
Yeah, happy to. It is quite interesting that I call it the Fertile Crescent of Buy Now, Pay Later has come out of Australia. There have been, including ours, a number of strong players in this space. The interesting thing, though, about Australia as a market, it's a small market. And so it really necessitates going broad. And the players that have evolved from Australia and other countries typically are providing it across all verticals, right? Any type of product you can possibly imagine. What we're able to do in the US, and the strategy that I'm very open about, is we go very narrow within these verticals, within 4 particular verticals very heavily: healthcare, auto service and repair, home improvement, and education. That allows us, in a country that's as large as the US, unlike New Zealand and Australia and the UK where we are, it allows us to have a higher volume of business and therefore have low loss rates, because in dental, for example, internationally, we're below 1% loss rate. And that, together with volume, allows us to have a lower cost of capital and to provide that ridiculously low APR. It's almost like Southwest Airlines, $200 round trip, LA to New York and back, right? The airlines thought it couldn't be done. That's really the combination that the US offers, whereas these other countries really are playing more in the smaller dollar, high volume side of buy now, pay later, because they just don't have the scale and the volume in those markets. So what you see also happening is, just like us, expansion into larger geographies that can carry some of the more diversified products, et cetera. But for us, being able to go narrow and deep, so we're kind of going about it a contrarian way. Where others are going broader, we're going narrower and deeper. I think a really interesting perspective on what's happening in those smaller markets versus here. Obviously, we can't have this conversation without talking about consolidation, because you see that this week, and you've seen joint ventures between some of the biggest players recently, and I'm sure your listeners all want to know, well, what's his take on that? It is a absolute commodity to provide credit for a $50, $100 pair of tennis shoes or t-shirts. Credit is going to be increasingly a commodity. So with that, paying for commodity as just a product or a tool capability, it is very hard for those paying fors to reach profitability. You just look at all of them, right? And unlike our margins, which are actually industry leading, they are at a unit level having to have massive, massive volume. So that begets consolidation, right? Business School 101. And there are some strategic aspects to some of these mergers, bringing together the capabilities of a big processor together with the capabilities, I say capabilities, but really the access to all the merchants and consumers that come through a processor, and the capabilities that are provided by a good buy now, pay later, paying for. That brings scale, but it has some strategic value as well, particularly with that access. I think that consolidation will continue. I think a lot of these BNPLs, particularly the paying fors that don't know how to handle a regulatory regime like either the FCA in the UK or the US, the CFPB, they will get scooped up by large players. And I think it's the large traditional players, not just the fintechs, that will scoop them up to play catch up, because they're losing money. I mean, there are some merchants losing double-digit revenue if they don't accept buy now, pay later. So if you're a processor and you've got merchants that are losing double-digit revenue and you don't have a solution for buy now, pay later, you're going to pretty quickly start evaluating other acquirers, processors. And so I think you'll see the processors continue to scoop up the buy now, pay later providers, the fintechs, and I think you'll also see some big banks to play catch up, because they're also feeling the pain, certainly on both the merchant services side and on the consumer side.
Yeah, that was actually something I had written on the side, is to ask about financial institutions, right? Because they sort of have that ecosystem. So what are they doing in this space? So you kind of talked about that. What do you think about companies like Facebook and Google? Are they going to get into this game?
I think everybody who wants to provide an option to consumers that helps smooth out a payment will absolutely want to get involved. This is not a trend. This is a fundamentally different and well-received way for consumers to pay and to plan and pay with something like OpenPay. But just to pay without planning, there's a lot of people out there that want that. Let me just remind something, because maybe this is not as obvious as I may think it is. instant credit at the point of sale is extremely powerful. When you say, I'm going to give you a credit card, I have no idea how you're going to use that credit card, Greg. I have no idea where you're going to use it. It might be a really risky merchant category. It might be for something that you can't afford. If I just give you a credit card, you're off. As long as they accept cards, typically you can pretty much use that general purpose card anywhere. So what's going to happen is that product is going to need to have a much higher APR and interest rate and fees and all sorts of other things because they've got to compensate for the risks that that issuer takes, which is much greater. Let's compare that to at the point of sale, where you know exactly what the person's buying. You know exactly what their credit score is at that moment because you're running the score there, not when they applied for a credit card 5 years ago. You're able to evaluate the merchant, all sorts of things, information at the moment of the transaction. Now you don't have to have a overabundance of caution with charging higher rates and fees and all these other things. Now, some still do that. In fact, some use a credit card format just for this whole process anyhow, but you don't have to. So there's a lot of power in instant credit at the point of sale for both the consumer, for the merchant, which drives up sales, and for the provider of the product. That's really important to understand. And that's why we're seeing this is not a trend. This is truly a better way to pay, particularly if you've got planning and payment like we have with OpenPay, where it's not pay it, spread it, and hope that nothing bad happens, and go home and figure out affordability later if the interest rate changes. Pay, plan. I know it's $5 a month, $5 every other week, whatever. I can pay for that. I can plan for that. But an instant credit at the point of sale is much more intelligent than a credit card, which is a blunt instrument for anything anybody wants to go out and buy.
Yeah, and we haven't really talked about, and maybe it's a non-factor, but a conversation that always comes up in payments, is this a retail point of sale product or is this an e-commerce product? I think the answer is both, but do you have a view on that?
Definitely both. Interestingly, our biggest verticals tend to be more at point of sale. So we integrate into the point of sale. In fact, you might have heard about our announcement with one of the largest processors in the world. You'll have OPI right there at the point of sale. So you go up and Amex, Visa, MasterCard, OpenPay. So that's pretty exciting and powerful. Healthcare, obviously a lot. Yeah, there's telemed, but most of it still is, right, point of sale. Home improvement, the auto repair and service. Education's interesting. That's our fourth big vertical here in the US. And of course, we've seen education increasingly go online. I think there was a trend there before COVID, but certainly COVID has accelerated that. But yes, buy now, pay later online, definitely important as well. Certainly skews more towards broader retail and purchasing smaller items. You see that Amazon has partnered with some to provide installment, various versions of installment on their site. So it is very applicable in both cases.
And then talking about the future and where this is heading, and you mentioned it a little bit, when do you think the consolidation is going to happen? I mean, is this imminent or is this 5 years out?
Well, it started. I mean, look, this week, if no one thought it was coming, look, I got probably, Greg, I'd say 50 to 100 calls yesterday. And of those calls, as a result of the Square AfterPay deal, and as a result of those calls, it was very clear that there are many of the processors, issuers, traditionals, fintechs that are saying, can they survive without having a partner? And would we be that partner? Or who would be that partner? There are solutions that are white labeled out there. And there's a company called Amount that actually white labels a solution that a lot of the banks are looking to use to provide this product. And then ultimately the bank owns it and owns the underwriting and the asset and all that kind of stuff. So they are very worried about this. That's going to cause consolidation. Let's call it one wave. One wave of consolidation is going to be those that fear that they're not in the game and they're realizing it's not going away. I think the second wave of consolidation is going to be the regulatory that I talked about earlier. I think once we start to see the effects, the ripple effects, and the impact on consumer from a lot of these pay in for in particular, but other practices, other gimmicks and tricks, we'll see the CFPB step up and say, you know what, we need to do more to protect the consumer and their credit history. And so there'll be another wave of those that just can't bear the cost of compliance, which all your bank listeners know very well. And then we'll see some of them get scooped up or merged together. I think there'll be some really interesting vertical consolidation. in this space, where you might have an ISV that controls the technology. Like I was talking about, we're integrated with dealer management systems and patient management systems. You may see some of the ISVs actually get into the space, and some of the technology providers participate, which will be very interesting. So I think at least two, if not maybe a third wave that could be mixed in there of consolidations. And I think it's already started. And I think it'll go on for the next couple of years. It will be exciting times. I'm enjoying being right in the middle of it, but I'm most excited about being behind a product that I really believe in, as you can tell.
Yeah, absolutely. Well, I wanted to rewind the clock a minute because I was at Chase Payment Tech back from 2004 to 2012, and we launched a product called Bill Me Later. And I'm sure you've heard of it. PayPal bought it like in 2008. So I was just thinking, what happened to this whole space? Because in 2008, it started to gain some momentum, right? I mean, they obviously, Bill Me Later was bought for millions of dollars, and they were integrated into Chase Payment Tech, one of the largest, if not the largest acquirers. But then from 2008 or 10 till now, or at least maybe to 2 years ago, there wasn't a lot going on in that space that I really know of. So I'm just curious, like, why now? Why did this sort of come on in the last 18 months as such an important part of the payments ecosystem?
Yeah, that's a really great question. I think when I look back at the pace of when it started to pick up, everybody might think it was purely COVID, but I was receiving, I'd say I did my first installment project when I was at Deloitte. I sold to a big network, and it was about 10 years ago, I want to say. That product, similar to what you were saying, got sort of ho-hum progress, nothing that interesting. About, I think you're right, 18 months ago, it went from one installment project for the merchants and financial institutions a year to one every 3 or 4 months. And then about a year ago to one a month. And then in the last year before I came over to OpenPay, the last really 6 months, we were getting multiple calls a week. So I think what we're seeing is the U.S. is a lagger when it comes to a lot of payments innovation. Look at chip and pin and all those kinds of things, right? Checks. I mean, the ability to get rid of checks out of our system. And adopt RTP, or real-time payments in general, RTGS. I think that consumers started to get wind of this from these other countries, and it started to come here naturally and would have grown at a healthy lower double-digit rate. I think with COVID, it put it on steroids, and people started to realize this is pretty easy. Certainly a great customer experience, a great UX, and those have really evolved. The ability to get rid of all the friction and to work with the bureaus to quickly bring this product, which didn't really exist in the way before, into sort of the mainstream. Because it was hard, it was difficult for them to figure out how to put this into the mainstream. They started to come up to speed and started to support it. And so you had both COVID, but you also had the ecosystem ready for it, and then the ecosystem providers now starting to lean into it. And in fact, that was sort of the ingredients to meet what was an increasing demand, and it's just worked. People love it. You look at the repeat use, very, very high. Some studies show that it's 60+%. We never saw that with mobile adoption and other forms of mobile payment. It just wasn't happening. And now moving into the larger ticket, longer term stuff, it's here to stay. And so I think we've kind of awoken a sleeping giant that other countries had. Look, they were way ahead of us, right? I mean, you go look at these other countries, they've had these buy now, pay later products for many, many years. And so, yeah, it's definitely been helped by COVID, but I think it would have been growing at a healthy pace even without COVID. I think consumers were just ready for it, and the providers were ready for it, and it finally came to land on American shores.
Yeah, and I think, like you said, COVID just accelerated so many things in this space and in many other spaces, but certainly within payments, I think COVID accelerated a lot of things. So I'm sure that was one of the factors to your point. Well, Brian, we've covered a lot of ground from your background and what exciting products you guys are bringing to the U.S. And then obviously, I think you've done a tremendous job educating all of us on this space. Is there anything else that you wanted to talk about before we wrap up?
No, I mean, I think it's exciting times. And I would, for merchants that are listening, I would strongly encourage you to do two things. One, not ignore this trend because I do think it's incredibly important. And second is provide choice. Don't give your customers exclusivity, particularly on products that inadvertently will cause them harm. I really want to make sure the merchants heard that today. And then for your financial institutions, it is time to find a dance partner. This is not going away, and cards will continue, credit card in particular will continue to decline. And this is a great product, if distributed correctly, can be really, really good for your customers, albeit it doesn't carry the same benefits in many cases on the interchange. But I think we all knew that interchange was continuing to compress anyhow. So it's a great spot to help your customers to build sort of lasting relationships with them. And we'd like to see customers have a buy now, pay later provider that's they can go to. While I don't think people should have exclusivity, I mean, I would leave you with this thought. It's better if you have a relationship with one provider so that you can manage all your plans in one place and reduce the chances of making inadvertently a late payment or something. And so for the financial institutions that do that well, and for the larger processors and fintechs that have a great way to interact with their customers, this is a product that should be there. And if you don't have a good way, well, you're probably in trouble anyhow. But I would really like to see us serve them kind of back into the old banking days, not with 50 institutions, but with one or two. Choice is important, but ultimately the ability to manage all these plans with one provider that can go from $50 up to $20,000 to me is the safer way for consumers. So just a few parting thoughts there, Greg, and thank you for having me.
Yeah, no, thank you so much. I know your time is very valuable, so thank you so much for being here.
Happy to. You take care.
All right. And to all you listeners out there, I thank you for your time as well. And until the next story.
Thank you for joining us this week on the Leaders in Payments podcast. Make sure you visit our website at leadersinpayments.com, where you can subscribe to the show and where you'll find our show notes. If you enjoyed listening, please share on your social channels as well.